Hey everyone, happy Tuesday. Welcome to a new week with the Final Bar. Today I'm talking with Bob Lang of Explosive Options. We'll talk about this market rally in the first quarter. Is this time different? Let's look at the charts together. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is designed to help you define the trend, right? Help you understand what's working and what's not. Increase what I call a situational awareness for the markets, understanding where the movements are, understanding where the opportunities are, and also what area of the market you want to avoid. We're sort of getting into the meat of earnings season. Today, we had an interesting sort of phenomenon with Goldman Sachs, Morgan Stanley, two names reporting on the same day, same sector, same group, completely binary outcomes, one gapping higher, one gapping lower. We'll look at those charts along with many others to make sense of this day. Let's continue and kick things off today with our market recap. We'll start with what happened with the major averages, then dig into as many charts as we can to sort of round out our time together here. The S&P 500 at the end of the day down about 0.2%. That's bounced a number of times up to that 4,000 level, but never really came above it. Actually pushed a higher above there just right out of the open, but then settled back down. So 4,000 just continues to be reinforced as sort of that big round number until we can get above there, in my opinion. How good really are things, right? How bullish are the markets if we can't get above a key level of resistance? That's one of the things we talked about with Bitcoin, right? And 18,000 or 20,000, or that line is, we've now seen it start to rotate, and others like Ethereum and others sort of following through as well. We're not quite getting that yet on the S&P. Now, what's interesting is a lot of the breadth indicators we'll look at, and with my guest today, Bob Lang, we'll look at some of the measures of breadth, which overall, fairly constructive, if not wildly constructive, wildly encouraging. So we'll look at that evidence and see what it might tell us about the strength potential of the market going forward. The Dow down quite a bit. Now you have some Dow members reporting earnings that can create quite a jump very quickly. So the Dow down about 1.1%. The Nasdaq Composite in the green, one of the few indexes we're tracking today in the positive. The VIX also pushing back to the upside. So you have stocks in general a little bit lower volatility going back to the upside. This was after the VIX sort of held that 20 level for quite some time. And then the last couple of weeks, we've now seen it push below 20 for the first time in quite some time. We're now pushing a little bit back up towards that 20 level from below. Other asset classes here, very quickly, we have bond prices moving lower through the course of the day. Interest rates, of course, generally moving higher in that sort of situation. The dollar index up a little bit. So honestly, really sort of a quiet day is how I would describe it. No big gaps, no big movements at the high level indexes. Now, on the individual stock level, we had a lot of movements, which we'll try to pick apart. But macro sort of big picture, I wouldn't describe this as a super noisy day. Commodities overall in the positive, but it was sort of the energy ag part of the commodity space and less precious metals. Gold down about 0.7%, silver down 1.4%. And that's after gold and silver have been certainly some of the better charts in the fourth quarter of last year, sort of settling in a little bit here in January. But overall, the rally in gold is a move we haven't seen in over a year, really, right? Going back to early 2021, we had a nice push, or in 22, when you saw a nice push to the upside there. Cryptocurrencies, I mentioned, overall moving, sort of rotating to the upside. You have Bitcoin all the way up above 21,000 today, just below 21,400, and Ether well above previous levels, now just below 1,600, which it tested earlier in the day here. So an incredible rotation in the cryptocurrency space, to be honest with you. A concerning rotation if you think about the how quickly it's accelerated to the upside, and any sort of momentum indicators are flashing an extreme overbought condition on things like Bitcoin and Ether, with an RSI up above 80 for most of those. We'll look at the chart of Bitcoin here in a few moments. Sector-wise, just to finish things off, and then let's look at a bunch of charts here. Technology number one, energy number two, everything else flat to down for the day, with materials industrials noticeably at the bottom of the list. When we did our market outlook special last Friday, had a really good conversation. Ended up being quite a focus on the commodity space. And we talked about energy and some of the long-term potential there, but also strength in industrials, things like defense stocks and aerospace, materials, right? Things like copper, Southern Copper and FCX, and other parts of the materials sector doing well, giving some of those gains back here overall today. Looking at a chart of the S&P 500, I keep reinforcing this trend line off of the 2022 highs. As a reminder, connect January 22 with March 22, with August 22, with November, December. It's not always this straightforward, but I feel like this is a real classic trend line analysis. Some of the times you look and you think, it's not a great chart for that. This is a really good example of where I think a trend line really captures the trend over time and really visually indicates the pace of this trend, right? It's been a fairly consistent downtrend from the beginning of 2022 to where we're at about a year later. The question is, can we get above that trend line? And I like to think of this sort of analysis as lines in the sand, right? What level, what signal, what move would you need to see to change your perspective or to acknowledge what I'd call a change of character in the chart? For me, getting above this trend line, getting above the 200-day moving average, ideally getting above 4,100, which would take us above the December highs, that's what would change this from a classic bear market rally phase where we're rallying into the upper end of a downtrend channel and something different, which would mean we actually don't stall out at resistance. We break through. We don't just trade up to the 200-day like we did in August. We actually follow through to the upside. We don't just trade up to this trend line like we did in November and December. We actually show that there's additional momentum, additional buying power that's coming in, able to push risk assets a little bit further. If we would come off, if earnings season starts to get pretty negative here through the course of this week, and we have a lot of companies reporting certainly that we can pay attention to, we will through the course of the week. If we start rotating lower, clear support at 3,800, right? That's the swing low in December. We sat there for a couple of weeks. As long as we hold that, things certainly aren't that bad. So we're sort of in this range. We're sort of in a question mark phase, a neutral phase. And the question is which way we break. The breadth conditions, as I mentioned, fairly constructive. And I know I'm going to talk with my guest, Bob Lang, today about some measures of market breadth. I just want to hit the one chart. When I was looking with my subscribers on Saturday, this was the chart that I highlighted, which was the advanced decline line, right? If you look at the S&P 500, look at the advanced decline line for the New York Stock Exchange, for the S&P large cap, S&P mid cap, S&P small cap, all four of those have broken above their December peak. So while the S&P itself is not above its December peak, while the Nasdaq certainly is not above its peak from the fourth quarter, you see that these measures of breadth, advanced decliners, are. So how does that happen? Well, the price of the S&P is based on a weighted measurement, essentially, of the companies, right? So the largest stocks, the mega cap stocks, have the biggest weight. These equal weighted measures of breadth are based on everything. It's just counting up the number of stocks closing higher or lower. When this happens, it tells you the leadership is not the mega caps. The leadership is other parts of the market, not maybe in those FANG sectors, but other parts. But overall, the fact that they're breaking out is not bearish. It's more constructive. We need to take a quick commercial break. We'll be back bringing on my guest, Bob Lang from Explosive Options. We'll see you in a minute. David Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. We have so much great content and great viewer experience types of things to upgrade for you. We're going to be in our new studio here very soon. We have a lot of great plans for the final bar, building out the time and everything. So we'll get a lot of updates for you here very, very soon. A couple quick announcements to share with you before we bring on today's guest. First off, we welcome your questions and your feedback, but particularly your questions as you are trying to apply the technical toolkit to these markets. You can get your questions to us for our mailbag segment via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to answer your question on Friday's show. Go to StockChartsTV.com. That is our on-demand platform. We have so much great content on there. Our Market Outlook special, as I mentioned, aired last week. Martin Pring and Bruce Frazier did their Market Outlook. We have Larry Williams with the 2023 Market Outlook. All of that stuff and so many great guest conversations are there for your liking. We're free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Just want to mention the schedule we have coming up here. I'm excited to talk to Bob Lang here in a few moments. Tomorrow on Wednesday, the 18th, we have Dana Lyons, portfolio manager at J. Lyons Fund Management. On Thursday, the 19th, our friend Tom Boley of Earnings Beats will be coming through. I had a great time talking with Tom along with Greg Schnell and Ms. Schneider for our market outlook. We'll take out some of the comments we had and further discuss our playbook here for the year. Next Tuesday, by the way, Willie Delwich of All Star Charts, fantastic macro strategist, is going to be joining us as well. Let's bring on today's guest, Bob Lang. Bob's the president of Explosive Options, a frequent guest on the show, always brings some good charts to help us try to make sense of things. Bob, Happy New Year. Welcome to the show.
Happy New Year, Dave. Always great to be with you, and welcome back from your time away. I'm sure the weather is much better in Seattle than it is out here in the in New England area.
That's tough. That's a low bar right there, Bob. But you're right. We're hanging in there. We have sort of the classic Seattle weather in January, and we'll take it. You said a couple charts with you, Bob, as we're trying to make sense of these markets. You were last on the show back in October, which ended up, we didn't really probably know it at the time, but ended up being right at the bottom before we rallied. Conditions certainly have changed since then. So can you talk us through what you're seeing today?
Boy, what a coincidence, right? It was literally right where the peak of the VIX is on the chart that you're talking about there. It was around the early part of October. And, Dave, I hear a lot of people talking about, the market's going to crash, market's going to do this and that. Of course, you and I, being technicians, we let the markets tell us what's going to happen. We don't tell it what to do. And, if somebody was missing out, they would look at the VIX and they'd say, my gosh, it looks like the VIX has already crashed. It's come down more than 50% from the peaks in the beginning of October to the bottoms there in where we're at right now, actually from last week, about 18%. So, what does this tell us? It just tells us that there's a lot less people who are willing to protect their portfolios into the markets right now. And we saw that starting to turn back in the early part of November, Dave, when the CPI number came out, and we saw a lot of volatility get sucked out of the markets there. It was around the beginning of November 10th. And you can see there's a huge bar there on that day. And it's gone down, it came down to around the 19 area, and then we rallied back in volatility, but we did make a lower high on this chart. Now, seriously, about 19%, I'm not really interested in getting too long this market. I'm looking for a bit of a pullback, and I'll actually see volatility start climbing back up to the mid-20s right now. But still, you have to be impressed by that move in volatility from the early part of October.
When you're thinking about the VIX, Bob, in your experience, I know a lot of people try to, just think about what it means relative to equities, to the S&P or the Nasdaq. When you think of the VIX in a level like 20, is it, in your opinion, the idea that you focus on a particular level like that, or is it more the trend in the VIX, or both of them? Like, what sort of signals would you derive from something like the VIX in your experience?
Well, I think the VIX is an ideal trend following tool. I hear a lot of people talking about the indicator when it's not moving, when it should be moving, that they think it's broken. Of course, that's ridiculous, because it's just an indicator. It's just telling us where money is flowing at a particular point in time. So I think it's a great trend indicator, Dave. I think when it tells us market momentum is moving in a certain direction, we get some really, really fast moves in markets when volatility is trending, and it's been trending down seriously for the past 3.5 months, since the beginning part of October. But it's been a slow motion to the downside on volatility. And you know what? We've had days when the VIX has gone up a little bit, Dave, and the market's gone crazy to the downside, and then we've had markets going up when the volatility has come down. And what we had here recently, Dave, and up until about the beginning of January, is a huge increase in what's known as realized volatility. We saw realized volatility climbing up to where implied volatility is. And what does that tell us? It tells us that you can't really rely, and when that happens, we can't really rely on implied volatility or the VIX to tell us what the market moves are going to be, because generally speaking, look, you get a 70 handle move in the S&P 500, that's 2%, and if the VIX is only moving 30 cents or something like that, you're thinking, well, what's going on here? It's simply explained by an increase in realized volatility, and that has actually come down quite sharply. It's down about 17-18%, but as it gets down to a single digit area, that's when it kind of gets dangerous for market longs to have some market equity risk exposure, because when that realized volatility starts to come down, we see people starting to take some protection using that implied volatility, the VIX, to protect those portfolios.
Got it. No, that's really, really helpful, Bob. Thanks for talking through all of that. I mentioned earlier in our market outlook or market recap about about breadth conditions, right? And certainly undeniable, we've seen quite a surge, breadth thrust, as a lot of people would describe it. This is your second chart. It's looking at the percent of stocks in the Nasdaq above the 20-day EMA. What can you tell us about this one?
Yeah, so Dave, this is a familiar chart. We've used this one a couple of different times, and I generally draw that box over there. Anything below the 50% line is I say it's called no bueno, no good, because it basically anything below the 50% line, it's telling you that half the stocks in the index are somewhat in bear markets. Now, this is of course is the Nasdaq. This is the 20 moving average, so not necessarily in a bear market. I look at another indicator like this, the S&P 500 stocks below their 50 moving average, not the 20. So the 20-day moving average is really good for me to tell me what kind of momentum the market has. And I use the Nasdaq because generally speaking, when the Nasdaq is leading, Dave, to the upside, it's pulling the rest of the market up with it. So it'll pull the Dow, it'll pull the Russell, and it'll also pull the S&P 500 along with it. So we see that the Nasdaq has really pushed high up here at levels we hadn't seen in well over a year. We're at, what is that, about 83, 84% last week of stocks above their 20-day moving average. And what is the 20-day moving average? Simply about a month worth of time above for the month worth of action. So we're talking about the middle of December here. From that point in time, the NASDAQ has really been the one index that has outperformed, and it could drag the rest of the market up.
Really, really interesting. And it's fascinating because the market's rallied in a lot of ways without some of these growth names really participating, but the breadth across the board seems to be rotating pretty in a pretty positive way. That leads us into your third chart, which is looking at new highs and new lows. What's the perspective here?
Well, you can see here that in this chart, the first two blue arrows, one on the left in August, and then there was one in November. And you can see that we started to make a nice move with new highs versus new lows. Now, we get the white candles when we have the new highs exceeding new lows. We get the dark red or the black candles, as you can see, in the middle of September, in the middle of June, when new lows are crushing new highs. But more recently, especially since the beginning of the year, since the end of December, you see a nice big cluster of new highs versus new lows. And that is a good signal. It's a green light, almost a yellowish green light right now for market players to get long this market, because this is an indicator that you want to see stay positive for a long period of time. It is more of a longer term indicator. It's probably one of the last indicators out there that hasn't turned bullish yet. We'd like to see a couple of closes above 100 on this indicator. So 100 new highs versus new lows, 2, maybe 3 days in a row, to give us a little bit more confirmation and confidence that we're going to see the strong breadth continue on going forward.
Now, when you mentioned earlier thinking there might be a bit of a pullback here, Bob, when you're looking at a chart of the S&P, as I mentioned in the market recap, we're really trading up into this resistance that I think we've faced before. Are there key levels that you're looking at on this chart, or what would convince you that this market is for real and that there's more upside to be had, or how are you approaching it this way?
So I'm looking at this chart, Dave, and I like to compare prior time periods, and I'm looking at the more recent action here from that peak at the middle of December to where we're at right now. It looks eerily similar to what we had back in mid-August to mid-September, doesn't it? And right there, very similar to that. However, look at the basing pattern that we have in December of about looks about 2 weeks versus what we had back in late August. Not really that strong back in August. So I look at this basing pattern here and this move up here as having a lot more possibility of getting through that 200-day moving average and that resistance level this time around. I'm always I'm from California, Dave, as you know, but sometimes when I'm in the markets, I'm from Missouri, and that's the show me state. So I want the markets to show me what it's all about, what it thinks here first. I want to have it show me first before I go ahead and make a commitment, because listen, you know what? I told somebody a long time ago that bull markets last a long time. Bear markets don't last very long, maybe a year and a half, 2 years. And so somebody was telling me more recently, said, but what if we're too bearish for too long? What if we miss out on that turn? Listen, you know what? We've seen bull markets run 12, 13, 15 years before they slow down. I'm not necessarily sure that's going to happen again, but you know what? The history shows us that bull markets last a lot longer than bear markets. So if you do happen to miss that turn, if you do happen to be late coming in, I don't think you're missing any out on any opportunity. Certainly, if you look at the last 100+ years, that opportunity has been there in the waiting. If we would just take the risk.
So much effort built into trying to capture the bottom again and right at the beginning. And I think what you and I have both found of our careers is being there for the bulk of the move can be pretty profitable as well. Bob, listen, thanks for giving us some time today. Thanks for going through with your charts and answering some questions. Be well there. Say hi to New England for us, and I will talk to you again soon. All right.
Great to be with you, Dave. Thanks again.
That's Bob Lang. Bob's the president of Explosive Options. I love those chart, the comment about, show me, right? Show me the money, show me the trend, show me the signal that confirms that something's happened. I think a lot of people do sort of wishful thinking type of analysis, right? Sort of, thinking of a narrative, thinking of a particular set of conditions, and then just sort of assuming that's what's going to play out. The technical toolkit, as I use it, and really as Bob was describing it, is more trend following, and it's more based on the weight of the evidence. And I think there's some interesting components on the S&P chart that could certainly confirm that. And I love his take on the breadth, really capturing the upside momentum shift that we've seen on a lot of areas, including the Nasdaq. I had not looked at that chart in quite some time. Great take there, as always, from Bob Lang from Explosive Options. We need to continue on our show today with the Final Bar mailbag. We have a little bit of time for a question or two, so we wanted to throw them in here. And recently, you guys asked this. You mentioned FSLR as a stock that produced a shooting star warning today. And this was last week, I think, when you sent this question in. Yet it's listed as the top scooter stock, the StockCharts technical ranking. How do you resolve that conflict? Shouldn't today's result reduce the scooter ranking? I really, really like this question. I want to thank you so much for sending that in. So the chart you're thinking about, because I think I feature this as one of my 3-on-3 or 3-and-3, and it was this day here. So this is last week, where you have the shooting star candle. So that's when you have an uptrend. Then you have a candle with a long upper shadow, a limited lower shadow, the open and close are near the lows of that range. And what that essentially means is, think of it as a shooting star coming down to earth. It's usually a bearish signal. It tells you the next 1 to 3 bars are most likely down. That didn't happen in this case, by the way. Obviously, First Solar continued to push to the upside, leading to today, which I don't know if you would call this a shooting star candle, because it's not ideal, but it started to look, as I was putting this question in, I'm like, oh my gosh, we might have another one today as we're doing it. But the point of your question is, how can the top ranked scooter stock show this bearish pattern? Wouldn't that downgrade it? And the answer is no, because candle patterns like that aren't included in the scooter rankings. The StockCharts technical ranking actually combines 3 different time periods: long-term, medium-term, short-term. It's weighted in each of those buckets, and it combines a series of things like moving averages, like MACD, PPO, like RSI, and a bunch of other things. If you want to know exactly what's included, go to the little magnifying glass in the upper right corner of our website, type SCTR, look for one of the Chart School articles about our scooter rankings. We'll share the formulas and explain exactly what we're doing. Candle signals are different. I actually find that really valuable, because when you find a top-ranked scooter stock, that means it's in an uptrend over time. The candle pattern is a very short-term candle pattern telling you something is changing in this short-term environment. So then you combine the longer-term trend with the shorter-term signal. So it's intentionally not included in the scooter ranking for that reason. So you can find stocks that are strong, showing short-term weakness, find charts that are long-term downtrends, showing a short-term buy signal. So that's why it was not included. And First Solar overall has continued higher from that point on. Thanks for that question. We need to wrap the show, folks, and go to the 3-and-3, 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 with the Kopic curve. The Kopic curve is an indicator created by a gentleman named Sedge Kopic. He was a market strategist in the 1960s, wrote an article for Barron's where he basically unveiled this indicator. There's a fascinating backstory to how he came up with it. And if you go to my YouTube channel, I actually just posted a video about an hour ago where I talked about the Kopic curve and shared the story and how to use it. Jesse Felder, who was on my show a couple of weeks ago, actually shared his version of the Kopic curve, and we looked at that bull and bear cycles. Essentially, what it's looking for is when the market is in a mourning period, as in you're mourning a lost loved one, and that happens when the Kopic curve goes below 0. And now you're looking for the slope to actually turn back positive. So it goes from a downtrend to an uptrend. You can see that happen right after the 2009 low, right after the 2003 low. And that's what I would be looking for here. The Kopic curve is now in a downtrend, telling you the conditions are bearish. Can we get a positive move month over month for the Kappa curve. That's why I think this might be a really interesting chart to watch through the course of this year. Chart number 2 is looking at Morgan Stanley versus Goldman Sachs, 2 stocks in the same sector, financials in the same group called investment services on our platform, both reporting earnings today and having 2 very different outcomes. You see Morgan Stanley gapping to the upside. You see Goldman Sachs not gapping, but certainly accelerating to the downside. Look how closely these charts match each other until today when you have this big difference. This is the opportunity, but also the challenge of single stock investing. You open yourself up or expose yourself to what's called company-specific risk, which is the risk not about financials, not about interest rates, not about a particular group or theme, but the individual companies and their ability to generate positive earnings. Because Morgan Stanley and Goldman Sachs, while related, are certainly very, very different. They have different business models in terms of where their revenues may be coming from, how diversified their portfolio of business might be. So great illustration of the fact that earnings season can cause some sudden shocks one way or the other. And I think this could be a preview of what kind of gaps we might see through the course of this earnings season. Our third 3-and-3 chart is Royal Caribbean RCL. And I wanted to highlight this chart. It's actually one of the top 10 stocks in our Scooter ranking. I think it's number 5 or 6 out of the top. We rank a large cap universe on a percentile ranking. It's a 98th percentile, which is pretty decent. Not often that we've had cruise lines in the top 10, which is why I want to highlight it. What's interesting about the chart of Royal Caribbean from July of last year is a pattern of higher highs and a pattern of higher lows. And even though we've had some pullbacks, even though we've had some drawdowns, overall, we keep pushing higher. This move above 60, I think, is the latest sign of further upside potential for the travel and tourism trade, particularly the cruise lines. Folks, that's a wrap for this show. I want to thank Bob Langer of Explosive Options joining us from New England, sharing some really good thoughts and charts with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe, and we'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.